Welcome back to Wealth Connection. I'm Jon Helm, and after a very busy couple of years in 2023 and 2024, I took a hiatus from this show to focus on my core business here at Raymond James. But now in July 2025, I'm excited to be back with a fantastic guest to reignite the show. Today's show is in part sponsored by Mackenzie Investments and is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. And now for the show. James, so good to have you here. I'm glad you're able to get out to the West Coast again. It's been a while. Welcome back to any of our watchers or listeners and clients and prospective clients, of course. Really excited to have James Cowan here today with us. James, we'll start with a bit of an introduction so that everyone knows who you are. You've been in the industry now for almost 40 years in private markets.
Over 40 years.
Over 40 years.
Over 40
okay.
years. I won't tell you how many over, but a little.
And you're currently Vice Chair Global Private Markets with Northleaf Capital Partners. Of course, prior to Northleaf, you spent 20 years at Macquarie Group, both in New York and Toronto, concentrating primarily on the infrastructure sector. That included both listed and private products, along with cross-border leasing, co-investments, and capital raisings. Your most recent position was CEO and president of MAM Americas, right? And in this role, you were managing two different private infrastructure funds. It helped develop new infrastructure and real estate investments for the institutional and, of course, high net worth market. Now, originally founded in 1969 as part of TD Bank, Northleaf was then spun out of the bank in 2009 following the global financial crisis, and then has grown to over $30 billion in AUM across three asset classes: private equity, private credit, and private infrastructure. And Northleaf being invested primarily in the United States, Canada, and Europe, with limited exposure to Australia and New Zealand. I'm really excited to have you here because private markets is a very interesting topic in the retail space these days. And I wanted to give people an insight as to how investors should look to allocate to these asset classes in their portfolios. So maybe we just jump right into it and have you explain the benefits of private markets versus traditional public market investments and how you feel about that.
Yeah, well, it's something that's been done by the super high net worth people and by institutions, foundations for decades and decades. So it's nothing new. What is new is that a whole lot of private managers such as ourselves have realized what's been happening for pretty much 20 years. And that is, not only is there more money in the non-institutional space, but it's growing more quickly. And so looking forward 5, 10, 15 years as a private equity, private markets manager, we need to go where the money is. And so that's why we're bringing these products out. You match that up with that it's actually been driven by those institutional and family offices, because what they see is they see return enhancement, low correlation to listed equities and listed debt. You get great diversification. You can have linkages to inflation. I mean, there are a whole bunch of things that you can get that are additive to your portfolio. Mm-hmm. And it's not just for diversification, which is most people think about it, but there are other opportunities to enhance your return over a long-term basis. Because what the private markets really specialize in is diverging from that quarterly call that all listed companies are driven by. And in fact, a lot of management are remunerated by. And what we really try and bring is that long-term view. So you're investing for the long term, and most individuals who save are saving for the long term. They're not saving quarter by quarter, they're saving for the long term. Yeah. So you really get that matchup of their future liabilities with their current assets, and they grow in to cover those liabilities.
So volatility being the enemy of the retail investor, that's a big benefit of alternatives. Took the words right out of my mouth as to what's the next benefit or what are the best benefits of alternatives. So what are all the asset classes that Northleaf covers, and why do you get into these spaces?
Well, it's a good question, because when people talk about alternatives, that can include hedge funds, commodity plays. Gold, is really popular right now. Mm-hmm. Bitcoin and everything else. Real estate, we don't do those. There's a lot of volatility in those. And that's not what we're seeking. So what we do is, you've heard Every time that there's some sort of economic upheaval, people say, well, there's a flight to quality.
Right.
What we try to do is be in quality assets all the time. And that's all about hitting singles and doubles, not going for triples, squeeze plays, home runs, and the like. And so what we see the advantage there is over a longer term basis is that if you look at private equity, private credit, and infrastructure, those give you three fantastic levers for anybody's portfolio. Private infrastructure will give you very high capital preservation, some yield along the way, and very good capital growth. Private equity is a great replacement for some of your listed equities because what it will give you is alpha generation, lower volatility, diversification, low correlation. And then private credit is a good replacement for some of your public debt. You should see 300 to 500 basis points, 3 to 5% higher than your typical bank rate, central bank rate, and again lower volatility over time, but very high cash yield. Right. So you get those three different asset classes, and they provide great solutions for long-term investors. And we've been doing those for a long time. Private equity going back into 1969. So we like just those three classes. The other asset classes I noted just a little bit too exciting for us.
So presumably because you've been in the space a long time, that helps in selecting your investments or just having the access to the discussion that goes on in private markets. So how do you select your ultimate investments?
So we work in what we call the mid-market. So that's companies, they're existing companies. We hope they're good companies, good management, good business plans, with somewhere between $15 and $80 million of EBITDA or cash flow. So they're real existing companies. But those are relatively small companies. We don't do the large cap transaction. So if there's a big company on the New York Stock Exchange being taken private, it's in all the newspapers, they're investment bankers, everybody knows about it. The mid-market, where there are in the core OECD where we operate, there are 300,000 or 400,000 mid-market companies.
Right.
So you really need to be in the flow. And that a big advantage is because we've been around for decades, because we have people, feet in the street in the different countries that we invest in, we work really hard to get in that flow, to hear about those opportunities. And we typically try to do no more than 1 in 20 opportunities that we do diligence, targeting more 1 in 25. So that gives us great selectivity. And because we invest in the same funds that our institutional and our retail investors invest in, it's our money. So when we go through that process of due diligencing and selecting investments, we're having on it as our own capital. And I think that's really important, that alignment with the retail investor, that we are cheek by jowl with them. Okay. So getting in the flow, looking at the opportunities in depth, and ensuring that we stick with what we do. We want sticky revenues across all three asset classes. So, they might be contractual with very high rates of renewal. And as I said, we're not doing storefront retail or commodity plays. We want to own or lend to the companies that provide the services people don't want to do without.
Right. It seems as though, especially in the infrastructure space and private equity space, getting access to things that the average retail investor just can't do.
Just can't get. So if you look, the largest economy by GDP in the world is the US by a mile, over any other country. The second largest economy in the world by GDP is the private markets in Western Europe, UK, Canada, US, Australia, New Zealand, where we invest. So if you're just investing in public securities, you're missing out on the second largest economy in the globe, which is democratic, rule of law, reasonably civilized. In addition to that, what we find really important or invigorating to people in terms of the investment is that there is just huge opportunity to select companies. And because we're mid-market, we are by definition, we're looking at regional, sub-regional, and even city, local. That local city might be Chicago, but it's still kind of local. So we don't run into the issues with trade and tariff that's going on right now. And it's those essential services that these companies provide, so that even if you think about it, if you lose your job, you still want your cell phone to work. So cell phone towers really important. We love owning cell phone towers. You still want consumer products such as cleaners or toilet paper. We really like companies that produce those. So we want to have those really sticky revenues, and that's available in the mid-market space. Not necessarily can you access those companies on the listed exchange.
Makes sense. Yeah, you can't just go to your FactSet terminal and look it up. You have to have those relationships long term that allow you to make a phone call or have a lunch meeting and hear about something. It's a much more nuanced space, right? So in the retail space, investors have been bounced around because of interest rate movements over the last number of years. In 2022 and early 2023, we saw the highest rising interest rate environment by a percentage basis ever. And how did that impact how you chose investments? What was the outcome to the portfolios, and where do we go from here?
Yeah, certainly there were several factors going through that. Not only the interest rate rise, but the looming Trump presidency, which also impacted our screen of companies. But rising interest rates affect the three asset classes that we invest in quite differently. So in infrastructure, rising interest rates typically are accompanied by inflation, and usually inflation comes first. Inflation actually is very good for infrastructure cash flow and valuation due to the nature of the asset class. So it's actually beneficial. In private credit, it really made a huge difference as opposed to bonds. A lot of people lost money in their bond books in 2021, 2022.
It might still be recovering.
And still recovering. Because our strategy is senior secured floating rate loans, we were able to pick all of that up. So that even last year, we distributed a net 12% to our investors. So we had some very strong years as the interest rates rose. Private equity was probably the one that was impacted a little adversely because, of course, there is leverage involved, as there are with all companies, and that will impact. But again, because we invest for a longer term, there were no fire sales. So while there may have been a short-term takedown on a multiple or so some valuations were either held constant or might have dropped a bit, that was only on paper. And so I think that patient investors, as we are, you didn't really see any impairment, true impairment or permanent impairment, I guess I should call it, of value in the private equity book. But it does impact each of the three asset classes differently, which is why you want to have that diversification.
Makes sense. One of the things that my clients have heard me say a lot over the years is to make sure that we weather the storm whenever there is a storm going on. How do you think about this with the current storm that's brewing with trade barriers? It's like an everyday sort of developing story. How do you think about that in the portfolio?
So in terms of risk, the biggest risk that we face in each of the different asset classes is obviously different. So in infrastructure, the biggest risk is always political.
Right.
And so in terms of the infrastructure industry in the United States right now, the renewables, the energy the energy transition, massive, hundreds and hundreds of billions of dollars. And it's been quite adversely affected going forward based on what the changes Trump has brought in. Smart investors, and we're able to do so for our investments, ensured that any government program was fully funded and contractually agreed so that we're not at risk. But going forward, there are going to be some severe impacts there. So in infrastructure, what would be a bad year, that black swan event, could be something quite significant. A number of years ago, a Labor government changed the rules, then a conservative government changed the rules, and essentially led to a number of their big water waste companies really going into insolvency and other big issues for some of the energy providers. So it's a real risk. Typically in the fixed income market, of course, it's interest rates, which is why we so favor floating rates. So because we have the floating rates, what you're looking more at is a hard recession, which would affect everybody. Mm-hmm. And how you protect yourself against that is through very high diversification. So in our private credit book, our largest individual exposure is, I think, 3.4, 3.6% of any one single name, and most all the rest are much more around the 1% range. So that's the best way to protect yourself. Private equity, again, it's there is that interest rate rise, but that's more again a general economic issue, and so again you want to have high diversification there. So rather than as an investor, many going in all in, what many institutional investors will do, they almost build a private equity ladder as they would build a bond ladder. So they're allocating over several years to get vintage diversification. What we seek to do through the three asset classes we have and how we've bundled up the product is by bringing it to market, we bring vintage diversification, which is unusual. Usually it's like invest in our fund and we have 15 different companies and we bought them in the last 3 years. And so you don't really get that vintage diversification, which is the biggest risk in private equity, I think. What we have got is we have companies that have been purchased over the last 10 or even 11 years. So very high diversification, and we continue to buy and add to it. So I think that that's how retail investors can avoid the biggest risks, is if they are going to go into the private markets, to ensure that they get highly diversified portfolios in each of those asset classes. And that's what we've striven to provide, working through Mackenzie, who has been able to help us bundle that up and make institutional products consumer friendly.
Thinking about how long-term you've been in some of these names versus some of your competitors, what is the exit strategy or the sell discipline that you embody in some of these products?
Well, it's really important to differentiate. Again, in the mid-market, we do not have that IPO risk. So large cap, which are the big brand name companies who go public, there is a risk. The IPO market could be shut down. In the last number of years, the IPO market has been very choppy throughout the core OECD countries. We don't bear that risk. So we're very happy not to have that risk. Generally, we are looking to sell to corporates, to a lot of other private asset managers who are upper mid-market or large cap. So we grow the company into their realm, and very happy to exit on that side. But every single opportunity, when it's first brought to any of our investment committees, you better have a very good exit strategy, or you're going to kind of be laughed out of the room.
Right.
Because the whole point is eventually our investors do want their money back. And that's how you prove that you've added value. It's one thing to say, yeah, we've got great cash flow and look at this model for the next 30 years, and we should do all of that work. But eventually, you need to prove that out by selling the company successfully and returning the cash to your investors.
Yeah. I mean, typically with these types of products that have been designed for retail investors, you have a monthly liquidity in these products, right? Does that impact your thinking on the risk side of the portfolio? Are there things that you wouldn't buy because of it's been designed a little bit more for a retail investor?
Again, a very good question, because what we've done, and Mackenzie has afforded us this luxury, is that all of the money, whether it's from me, from you, your clients, any institutional investor, it all goes into the same pool of funds. So we stick to the same tried true strategy that has given us our above market returns. The liquidity, the enhanced liquidity, is added at the Mackenzie level. And there's also, they add other features such as a T3 rather than very complicated limited partnership tax treatment. And instead of 12 or 15 year lockup, you have quarterly redemption. So we've been able to, by partnering with Mackenzie, take that institutional product and shift over. So if we were to have a different strategy for a retail product, then retail people shouldn't be investing in that, because that's not what we do. We want to just continue to what we're doing. Regardless of where the money comes from, we're going to make the same sort of good investment decisions that I think we've been making for years.
So it sounds like the size of Mackenzie taking on Northleaf in the last little while has benefited the portfolios.
I think so. I mean, we certainly, we started out being 100% institutional and staff money. Maybe now we're 95% institutional and staff money. In 5 years, it'll probably be 75%, 25%, because there's so much institutional money and so many people looking for good long-term stable returns, private markets is a great answer for them.
So thinking about the high net worth space again, that to go back to this a little bit, why would a high net worth family or even just a business that wants to have a little bit of exposure to this, why would they go through a retail product rather than direct to an institutional manager like Northleaf?
Yeah, there are a number of reasons. The first is that it's usually a 10 million US ticket per fund. And so with the Mackenzie product, we've wrapped up several funds. So you get great diversification. So you'd pay your 10 million US, but you wouldn't get the same diversification or anywhere close to it. You're also going to be locked up from anywhere from 10 to 15 years rather than quarterly. You get the limited partnership rather than T3. Tax reporting, you get multiple capital calls. You can have 15, even 20 calls per fund. With the Mackenzie product, you get one capital call. And you also have someone, the whole Mackenzie network, and they have 50 odd people facing investors. So you get more timely information really than our institutional investors want. So there are a whole lot of advantages there that allow you to get the same returns, but you get greater diversification, you get simpler tax reporting, and it's just overall it's a much simpler access point.
When you see how many of these types of products have come to the retail markets over the last few years, do you worry about that at all from a risk standpoint of how many of these things do exist now for retail investors? Like, does it become more of a worry with, you used to be able to have 10 or 15 year lockups. Now there's a growing portion of assets, not just with Northleaf, but all sorts of dozens of others that are in this space that could move money much quicker than the industry is used to. Does that factor into how you build these things?
Well, in terms of how we're doing it, because we're using the same funds, that flow doesn't impact us, the underlying investment thesis or strategy, which I think is really important. For the brokers, financial advisors, and investors, I think there is heightened risk because if there are four options, you can actually do due diligence on four different managers and their strategies, their team, their track record. If there are 104, you can't. And that makes it very difficult. In the institutional world, that is why you have proliferation of consultants. And so what will happen is an institution will say, we want to do a private equity mid-market core OECD. They'll hire a Mercer or Cambridge or someone who will look at the 104, come and say, here are six. Let's call those six in. We'll do a beauty parade, and then you pick one or two. It's much harder to do that for a retail investor. And that's why I think it's so important that firms such as ourselves get out and talk to people and say, we're not a flash in the pan. We've been around since '69, which I think is really important. Our track record is decades old. Our team, this is our team. These are the people, they've been around. The alignment, how we get paid is by being able to invest in the funds. And if the funds do really well, we get a performance fee. If the funds only do okay, 7-8% net return, we get no performance fee. And how we get paid is through performance fee. And then also that whole structure allows us to retain the best and brightest people. And so it does fall upon the financial advisor that they need to do the 4T test, which is the trust, team, track record, and investment thesis. So that's a lot of work you're going to have to do on behalf of your investors.
It's one of the big advantages of being with a massive firm like Raymond James that harkens back to pre-Canadian Confederation. We have a huge team of analysts to essentially gatekeep this type of product from making it onto our desk initially. And so just the best of the best things will be on our shelf. And then we can have all sorts of access to that research team to advance our cause for our clients. But think about those clients and going to sort of my last question around portfolio construction. In an ideal asset allocation, where do we place this? How much do we go into privates and alternatives? Because we can't buy everything. And if we're only buying 1% positions in things, it doesn't make a meaningful difference. So what do you envision for allocations for an appropriate mixture for a client?
Well, I agree with you. The 1 or 2% is going to move the needle. So I think that 5% is where you should start on each of the three asset classes. And because they deliver different types of returns and different types of long-term growth. I like all three. 5% in private equity, you get that long-term growth. 5% to private credit, you're getting yield and it's floating rate, so that goes in a positive sense. And then 5% to infrastructure, which gives you very high capital preservation, a bit of yield and capital growth, again, over the long term. And so 15%, I think, works well. If you were to, say, take another step forward and go towards the 30%, I would suggest that you, as much as if you want to give us the rest of the money, that's fine, but I would suggest not. I see it as there are three options in each of those. There's a mid-market core OECD, large cap core OECD, and an emerging markets manager. Mid-market is where the highest returns on a long-term basis have been generated, and there are a variety of reasons, but essentially there are way more deals and way more opportunities than in the large cap. And emerging market, of course, has its own separate set of risks. But by having the mid cap and then either building large cap or adding in emerging market, you bring a different type of risk, different type of return profile. And that's where I see people going. To go beyond 30%, I think you would actually, for high net worth people, you should probably be looking to other diversifiers, whether that be art, fine wines, watches, hedge funds, and the like.
Right. Makes sense. I appreciate your time, James. I want to give a thank you to Mackenzie Investments as well, who is partially sponsoring this episode. So thanks for coming out and visiting.
My pleasure. Happy to be here.
Yeah, it's great.
All right. Thank
Wonderful.
you very much.
This discussion may contain forward-looking information which reflect our or third-party current expectations or forecasts of future events. Forward-looking information is inherently subject to, among other things, risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. These risks, uncertainties, and assumptions include, without limitation, general economic, political, and market factors, interest and foreign exchange rates, the volatility of equity and capital markets, business competition, technological changes, changes in government regulation, changes in tax laws, unexpected judicial or regulatory proceedings, and catastrophic events. Please consider these and other factors carefully and not place undue reliance on forward-looking information. The forward-looking information will in all circumstances be updated, supplemented, or revised, whether as a result of new information, changing circumstances, future events, or otherwise. The content of this podcast, including facts, views, opinions, recommendations, descriptions of or references to products or securities, is not to be used or construed as investment advice, as an offer to sell, or the solicitation of an offer to buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Although we endeavor to ensure its accuracy and completeness, we assume no responsibility for any reliance upon it. Raymond James advisors are not tax advisors, and we recommend clients seek independent advice from a professional advisor on tax-related matters. The views are those of Jon Helm and not necessarily of those of Raymond James Limited. Securities products and services are offered through Raymond James Limited, a member of the Canadian Investor Protection Fund. Insurance products and services are offered through Raymond James Financial Planning Services. Raymond James USA advisors may only conduct business with the residents of the states or jurisdictions where they are found to be registered. And Raymond James USA is a member of FINRA SIPC.